How to time the market like a real estate expert. That's today's show. Let's dive into it. Hey everyone, welcome to the Investing in Real Estate show. I'm Clayton Morris, longtime real estate investor. Of course, a couple of years ago, left my day job in the TV world after 18 years of doing morning television to focus on rental real estate and buy and hold real estate. And that's what we do today. And we have a special guest on the show today, an expert in a space near and dear to my heart, someone who actually in Manhattan, right where I worked, right down the street in the city of Manhattan a few years ago, who knows that market better than anyone. But we're going to look at some of the data so you can step outside of New York City. It could be Seattle, it could be other areas, and understanding when is the right time to jump into perhaps a soft market, which we might be seeing right now in New York City. My guest today is Janine Yorio. She is the founder and CEO of Compound, a real estate investment technology company that was named in Inc. magazine's 50 world-changing startups to watch. And she knows New York City better than anyone. Janine, nice to see you today. Welcome to the show.
Thank you.
All right,
I don't think it's fair to say I know New York City better than anyone. That's a pretty deep field you're talking about.
That's true. Well, I guess in this space, when you talk about investing in the city, there's probably a small group, right? I know in certain towns where I invest, you hear the names come up on a regular basis, right? There's like a certain group of people that continually pop up. Is it a small knit community for you in Manhattan?
Well, New York City has a tremendous variety of institutional investors and individual investors too. So it's not really a small community, but what we're doing and the approach we take is buying individual condominium units in small apartment buildings. And in that niche, there are very few professional investors. Most of that inventory is held by end users who live in the apartments, or foreign investors who hold them as investments but don't necessarily run them as professional investments. So I think as you get really granular with how you slice up the Manhattan market, we are a very unique player. We're an institutional buyer in a non-institutional market.
So one of your big missions is making big cities accessible for anyone to invest in. I mean, because to me, I worked like right near 30 Rock in Midtown Manhattan. It seemed kind of terrifying to me that I'm going to invest in real estate in that space, or you're playing with you hear the names like Trump and other things, of course, and it seems scary. Or you learn that the Chinese government just bought up this entire building down here, and as if you're just getting started in the real estate investing space, that can seem incredibly intimidating. How do you demystify that for people and make it accessible for someone who does want to invest in a city like New York City?
Well, I think like any other market, I assume that you give advice, which is start small. Mm-hmm. And you don't have to compete with large Chinese conglomerates right out of the gate. You can start by buying one individual condominium unit, although in Manhattan, the average price of a condominium is still well over $2 million. So it's a small investment relative to the broader landscape in Manhattan, but it's still a pretty big investment for individual investors.
So it's still broad enough for people to play in that space. How did you get started in this? How did you get started investing in real estate? And was New York City your first go of it?
So I've been working in real estate investment for a few decades now. I went to college in the Northeast and I moved to New York City right after college. And then I went to work for a real estate private equity firm. So I worked as a professional investor, managing investments that were 50 to 100 to even a couple $100 million in size. I've lived and worked in New York City since graduation, and I've watched people all around me get really wealthy unintentionally. They bought apartments back in the late 90s. Some of them even had the fortune to buy in the early 80s. And just by sheer, not dumb luck, they were obviously smart and had a bit of foresight, but merely by buying an apartment and living in it and holding it, they've created tremendous wealth for themselves. And that's a story that pretty much everybody who lives and works in New York City has a relative, a friend that they know who bought a loft in Soho in the late 90s for $800,000. It's worth 10 or 12 million today. So there's been tremendous wealth creation for the people who've had the capital required to get in on the ownership ladder here. And what I see as the opportunity is broadening the universe of people who can actually participate in that wealth creation opportunity and invest in these big cities, which tend to be relatively expensive, especially for the starting entry point to invest.
We're going to talk about timing the market and when to get in, specifically in an area like New York City. Some of the areas that I invest in, the Midwest and other smaller areas, there's not as much volatility. There's not as I don't see these big market swings like you see in San Francisco or Miami or New York City. And they're relatively boring, to be honest with you. So I bet there's quite a bit more of a roller coaster ride to watch happen in Manhattan. But before we get there into the timing the market question, you talk about getting access to these types of cities. You see it broadening. How do you see it broadening? What things are opening up? What tools are opening up to people that they can go into a city like New York City and become a part of an investment group?
Well, I don't see many of them, and I don't want to turn this into a shameless plug for my platform, but Compound is building specific funds designed for smaller investors to invest smaller amounts and pool their capital into a giant portfolio that's professionally managed and buys residential real estate in that city. Are there other tools? I mean, there are a lot of technology platforms that help investors invest from afar, but they're generally platforms like Roofstock, where they help you invest in single family homes, primarily in the outskirts of major markets or secondary and tertiary cities. So in terms of tools that are available for smaller investors to invest in these big cities, they are at this point fairly limited, which is why we saw a tremendous opportunity, and it's why we're building Compound.
So with Compound, so let's talk about, I mentioned that's basically a crowdfunding platform, right? So someone can get in on that?
Not really. I mean, I see
Okay.
crowdfunding loosely defined is raising capital online. That's what crowdfunding is. So if that's what crowdfunding is, then even Blackstone is doing crowdfunding. They have a
Right.
REIT, they raise capital online. I try very hard to distance what we're doing from crowdfunding in the traditional sense, because we are looking to sell our securities online and also offline. So it's not just a direct-to-consumer platform. We work with traditional broker-dealers and investment banks to sell our securities as well. And all of our securities file public filings, so there's tremendous transparency in the acquisitions we make, what the underlying financials are. So it's just a different sort of platform that's meant to feel more institutional and have more radical transparency.
Great. Okay. So good. Thank you for setting the record straight on that. It's an opportunity for you to do so here on our show. So more of an institutional play, so someone can invest through Compound into some of these larger development deals in Manhattan. What is the sort of a minimum or a barrier to entry for someone to get into Compound that wants to invest? Is there a $5,000 minimum? Is there a $50,000, $100,000? Do they have to be accredited, non-accredited? What are some of the thresholds they have to meet?
So we have two funds live today. One invests in Manhattan residential real estate, and the minimum there is $25,000. We also have a Queens HQ2 fund that's designed to invest in real estate that we believe will benefit from the new Amazon headquarters location, and the minimum for that fund is $10,000. And both of these funds are today only open to accredited investors. But what makes our funds unique is that we intend to list them on the New York Stock Exchange, so that they trade publicly, so that you'll be able to trade in and out of them whenever you want to. And once they're listed, anybody can buy shares. You won't have to be accredited, and the minimum would be one share, which is about $10.
And so how is the investment structured for someone who does buy into it? Is it treated as a stock, more like a REIT, or are they having fractional LLC ownership with a group of other investors? How does that work?
Each fund is structured as a REIT. So the investor owns shares in the REIT. It's taxed as a REIT and will follow all of the REIT laws. And it's a company that goes out and buys residential real estate, and the investors will receive dividends, which are derived from the rental income from the portfolio.
Great. And are those paid quarterly, monthly? How do the dividends work?
Quarterly.
Quarterly. Great. Well, fascinating. And people can check. We'll have links to everything we just talked about in our show notes so people can check that out. But I do want to talk about this timing the market. And obviously, this is top of mind as we talk about this right now in the real estate market. Obviously, we see what's happening with Amazon coming to that neck of the woods. But you and I were talking before the show, and you described investing in Manhattan or the Manhattan market right now as pretty soft. First of all, what do you mean by that?
So when we look historically at Manhattan residential real estate prices have in time appreciated much more quickly than most other major asset classes. If you compare condos in Manhattan to the S&P 500 or gold, it's appreciated at a rate that's almost 3 times as much. And that's over varying time frames. What that means is that it kind of doesn't matter when you invest in Manhattan, as long as you invest and hold for the long term. That being said, if you look at the past 20 years, there have been two other major declines in the market. The first happened after 9/11, and the second happened during the Great Recession of 2008 and 2009. After 9/11, prices fell in New York City for exactly 6 months before they started to rebound again. In 2008, 2009, after the subprime, Lehman Brothers crisis, et cetera, the market fell for exactly 1 year before it started to improve again. So New York City has notoriously short dips. It dips and it quickly bottoms, it bounces back up. Now, right now, New York City is in a 3-year period of decline. The market peaked in 2015 and has been declining steadily since then. So it's a very unique timing in the Manhattan market because normally the dips are fast and this time has been prolonged. And I think a lot of people have been sitting on the sidelines trying to tick the bottom. One thing about humans that we know for certain is that they're really bad at timing markets because when markets start to decline, people get afraid. And then once they start to pick up again, that's when people invest. And if you can overcome your fears and look at this investment as a long-term play, now is a really interesting time to consider buying and averaging into the market.
So some real nuggets there that you just provided. If we know anything about the human condition, it's right. It's that we have this fear of jumping into it. We read these news reports, we see the 6 o'clock news, people talking about the housing market, new construction trickling down. There's not so much new construction happening, and that can scare you, right?
Sounds scary. Sounds terrifying. To quote Warren Buffett, I hate to quote the same quotes that everybody quotes, but they do that because they're great. Be greedy when others are fearful, and be fearful when others are greedy. And if you can overcome your own internal biases, which are totally rational and normal, and acknowledge that when everybody else is afraid to touch the market, it might very well be the best time to enter it, then you can go out and find some good deals. And we've actually been scouring the market. What's interesting to me, and full disclosure, I personally am also looking to buy residential real estate in Manhattan for my own personal use because I think it's such a great time to buy. And we're seeing bids. I'm going to open houses with my family and bidding on properties where sellers are entertaining bids that are 10 and 15% below ask, which is insane for Manhattan. So if you have the guts to go out and do the work and find the deals, you can get really attractive pricing right now. It's also winter, and winter, if you look at historical norms, winter is the best time to buy in New York City. It's cold here. People don't want to do the work on the weekends. They want to stay inside and watch Netflix. So now is a really good time to go out and buy New York City. That's what we believe at Compound, and it's what I believe personally.
And I think across the country also. I mean, I see this in the markets I invest in the Midwest, whether it's Indiana, Michigan, Ohio, and those types of places. No one wants to go outside when it's freezing. You have the polar vortex coming through, and that's when you can find great deals. And so, people ask me all the time in our YouTube comments and other places, they're saying, I hear the news. Are we headed for a housing recession? Are we heading for the housing bubble? Should I not buy? I said, well, it's up to you if you buy. I know I just bought 3 properties last week, so I don't know what you're going to do. But to me, I see cash flow and real value in these areas where people are talking about we're heading for a recession.
Well, you talked about volatility in the middle of the country compared to volatility in New York City, and I think there's a misconception that because they're high and they tend to appreciate quickly that the market is more volatile. And obviously, volatility is both upward swings and downward swings. But what's interesting is that in New York City, cap rates tend to be more, they trade within a more narrow band, whereas take a market like Indianapolis, cap rates, when I first started working as an investor, like I mentioned a couple decades ago, cap rates would have been 7 to 10% in a market like Indianapolis, and they've compressed down to 5-6%. If all of a sudden we find ourselves back in an environment where interest rates are high again, and cap rates in Indiana revert back to their historical means, there's going to be tremendous declines in value in those assets and a lot more volatility there. In New York City, you don't have the same movement in cap rates. It's a tighter band that things trade within because it's viewed as a less risky asset class. So even in a rising interest rate environment, there should be less volatility in Manhattan.
Oh, interesting. Yeah, you bring up a great point because even in our Indianapolis market, we used to do a ton of deals in Indianapolis. We've really stopped doing a lot of stuff there because the cap rates have really compressed. It's not as sexy anymore, and the numbers just aren't there.
And I'm not picking out Indianapolis specifically. I'm just talking about places where you don't have those kind of intrinsic scarcity value that you have in New York City, or places with tremendous job growth like Austin markets that tend to be more kind of steady. And those are places where cap rates have compressed, and it sort of defies logic. It doesn't make a ton of sense why those markets are being viewed as less risky and people are willing to take lower returns there.
Yeah, it is interesting. And, it's certainly interesting to watch these tea leaves right now. And you're seeing what's happening in the construction space, the luxury home markets right now. The lower income properties not being built, affordable housing. There's there's a dearth of affordable housing right now. What do you see going forward? I mean, we're in such a weird time. You said it yourself. New York City in a weird 3-year cycle right now. If someone had to come to you and say, let it be me, I'll come to you, Janine. Let's look at what's going on in the marketplace right now. We're seeking some advice on where we're going to put some money. Do you see a housing recession coming? Do you see a housing crisis coming? Or do you think that that's total hogwash?
Well, okay, so I just read Ray Dalio's book a couple months ago. And
Principles?
and he timed a bottom in the market back in the 80s and was completely wrong. And he writes about it in his book as being one of those things that he feels genuinely sort of embarrassed about having done. Even the smartest people, even guys like Ray Dalio, are notoriously bad at predicting when markets are going to bottom or what exactly is going to happen. So I don't pretend to have a crystal ball. My thesis is just that if you want to buy and hold for the long term, this isn't Bitcoin, this isn't fix and flip. This is get into a market that has historically generated returns of like 8 to 10% a year. Buy now because it's an interesting time to buy and you can find good deals. Is it going to be the best time ever? I don't know. Nobody knows. But I think it's still a really good time. As far as the broader housing market is concerned, I mean, all signs point to a housing slump. There's been a ton of new building. I've watched as lenders have been really aggressively financing both built to suit for SFR, where developers are actually building product that's single family homes designed to just be rented out long term. The lending market has gotten really frothy to the point where they're very aggressively lending to the house flippers. All of those things to me smell very similar to what happened in 2008, 2009 in the subprime crisis when spreads came in really tight on things that just before that point were viewed as really risky. A lot of those same things are happening now, but whether that means there's going to be a housing crash or not, I'm not sure.
Yeah, you bring up a great point. We just did a show on that specific point you made about how I think it was one group, I forget the name of the group that is building, an entire subdivision right now, but just for single family rental properties. They're not building them to sell. They're not building them to sell to retail buyers. They're building them so that they will hold them in their portfolio as rental properties.
Right.
Did we see that in 2008, 2009? Because I don't
know. This whole SFR, look, people have always bought homes to rent out. That's been happening since medieval times, right? Feudal landlords owned small homes, rented them out in the
Roman
castle
Empire.
walls. So that's not new. But what is new is that big institutions, the Blackstones, the Starwoods, the Carlyles, have decided that SFR is actually a real asset class, and they've poured hundreds of millions of dollars, billions of dollars into the space. And so there's been this validation that this is not just something for your rich aunt to do with her, her retirement savings, but it's something that big institutions should look to because it's been actually a way to find yield. And in this low interest rate environment, everybody's always looking for yield. The big SFR plays came out of all of the bank-owned portfolios in 08, 09, and they were acquired after the slump. And now that there's all of this capital that's flooded that space, I think developers see an opportunity. They see a new group to sell to. And so they're building spec homes designed to rent out. So that's a very new thing that is really followed on the heels of the institutions running into the SFR market.
What's next for you? What's next as you look at 2019 to 2020? Where do you see the biggest plays right now?
Well, I'm really bullish on New York City long term. I always have been. I think it's, at the risk of alienating some of your viewers, I think it's the best city in the world. It's an island. It's 22 square miles with a huge park at the center of it. So there'll never be more of it. I think Miami is a really interesting opportunity right now. I think San Francisco, as much as we all they're like the patriots of markets in the sense that it's always been. But it's a peninsula. It's a finite landmass. And I might get the numbers a little bit wrong, but generally the direction is correct. They added 700,000 jobs over the past couple of years and only 100,000 new housing units. So you look at where their housing prices have gone, it's been like this, and maybe that's unsustainable long term, but if you believe in supply and demand, San Francisco isn't going anywhere, and it's going to continue to be a tight market that the average person cannot afford to buy in. I think the other major markets, there's a lot of overbuilding in a lot of places. If we want to look overseas, which I don't think your newscast covers, I think London is super interesting right now because of Brexit. The market is really soft, and London, like New York, it's never going anywhere. You know, there's a reason why London has been a global capital for centuries, and I'm very bullish on London long term. And once it sorts itself out, I think value play there too.
Interesting. Yeah, in San Francisco, I know a theater where I used to go out to cover Apple events on a regular basis, and there's a theater, a buddy of mine held one of his live events. I think it held like 1,000 people or 800 people. They just lost their lease because the building owner wants to tear it down. It was only 1 or 2 stories. They're going to tear it down and build a high rise for condo units because, you know, why lease it out to theater performances when they could make 20 times the amount by tearing it down and building a new high rise on that space? So yeah, it's happening.
Yeah, no, I agree.
Well, Janine, it's been great having you here on the show. What's next for Compound? How can people get a hold of you on that regard? We'll have links to that below here in the show notes so people can click on that and check it out.
I am notoriously responsive, so people can email me directly. My contact information is all over the internet. Our website, you'll throw a link up to. I'm on Twitter. We have a company Twitter feed and also my personal handle, Janine Yorio. You can find those ways and consider Compound as a platform for you to invest in one of the markets that's notoriously difficult for individual investors to invest in.
Great stuff. Love the sounds of that. Janine, thank you so much for joining us, and we'd love to have you back on as this Amazon story unfolds. It'll be really interesting to see what happens. And, you know, heck, reach out to us. Once you start to see some signs that this 3-year trend is starting to stop, I'd love to have you back on. We can talk about the shifting movement in Manhattan as well.
Great. Thank you so much, Clayton.
Thank you so much. And thanks to all of you for downloading and subscribing and pushing us up to the top of the charts. As always, we just passed the 100,000 subscriber mark here on the channel. So depending on when you're seeing this, thank you so much for all of your subscriptions, all of your interactions, and sharing this with other people who want to build financial intelligence and become a real estate investor. We'll see you next time, everyone.